S&P futures are flat at 5,940. The NASDAQ 100 is effectively unchanged, down maybe 0.1%.
Yeah.
If you're looking at your screens right now, waiting for the bell on this Monday, February 23rd, 2026, it looks like a standard sleepy start to the week.
Right, but do not let that price action fool you.
Yeah.
Because if you scratch the surface of this calm, you realize the market isn't sleeping at all. It's actually in a massive defensive crouch.
A macro void.
Exactly. We are staring into a macro void, and frankly, the setup for this morning is incredibly dangerous.
Which is exactly why we're doing this deep dive right now. A defensive crouch is not what you want to hear when you're looking at your pre-market book. We need to figure out why this low volatility is actually a trap specifically, a liquidity trap.
Right.
And we've got a massive rotation happening under the hood, pulling capital out of the software darlings and shoving it right into heavy infrastructure.
Plus, we have to break down the pain trade.
The bond market mechanism.
Yeah, that hidden mechanism clicking into place right now. Listen, if you are only watching the stock ticker today, you're going to miss the freight train coming down the tracks.
All right, let's start with the immediate setup. The VIX is sitting at a 3-month low. Typically, when the fear index is this crushed, I'm thinking green lights, clear skies, buy the depth. Why are the sources flagging a low VIX as a warning sign today?
Because context is everything. In this specific environment, low volatility doesn't mean safety. It means coiled.
Coiled.
Yeah, the market is completely paralyzed by PCE anxiety ahead of Friday's inflation print. Think about the narrative shift we've seen over the last 24 months.
Oh, it's night and day.
Exactly. For 2 years, the only thing that mattered was AI expansion. How fast can you grow? How many GPUs can you rack? Growth at literally any cost.
Right, and now the bill has come due.
The narrative has shifted entirely to margin compression. It's no longer about how big you can get. It's about how efficiently you can run. And because everyone is waiting for Friday's data to confirm whether the Fed is going to cut or hold,
Liquidity just dries up.
completely dries up,
Right.
which creates the liquidity trap.
Walk us through the mechanics of that. When you say liquidity trap, what does that actually look like for a retail trader trying to scalp a few points off the open?
It looks like stop hunting.
Predatory algo behavior.
Yeah, pure predatory behavior by high-frequency algorithms. Because there's no real institutional volume stepping in, prices are wicking above resistance levels and below support levels just for a moment.
Like 30 seconds, maybe a minute.
Yeah, just long enough to trigger the breakout signals, and then they violently snap back to the mean.
So the algo pushes the price just high enough to bait you.
Exactly. You see the price cross a key level, you think, all right, here we go, the breakout is real, and you buy in.
But you're buying into a vacuum.
You're buying into a total vacuum. There is zero institutional support behind that move. As soon as your order fills, the price flushes. You didn't catch a wave. You just provided exit liquidity for a machine.
Dan, that is brutal.
Okay.
It's essentially a fake-out market.
It is. The research is explicit here. Retail traders are getting queued up chasing these fake breakouts because the whales, the big asset managers, they're sitting on their hands until Friday.
Which brings us to the tactical playbook from the source material. It explicitly says this is a day for scalpers, not swing traders. And there's a huge warning in there. Avoid market orders.
Absolutely.
Why is that distinction so critical this morning?
Because in a liquidity trap, your order book is completely thin. There are massive air pockets in the bid-ask spread.
Right.
So if you throw a market order out there, you're telling the exchange, fill me at any price. In a thin market, that quote-unquote any price might be significantly worse than the last trade you saw printed on the screen.
You're guaranteeing yourself a terrible fill.
You're starting the trade in the red, limit orders only at the extremes today.
Yeah.
And there's a specific metric you need to watch on the S&P 500 futures.
The volume hurdle.
Right. If the ES doesn't clear the 6,140 level with a 30% increase in relative volume, the move is a fake.
A 30% volume spike. That's a massive hurdle for Monday morning.
It's huge. It basically means unless you see the institutions aggressively stepping in with heavy volume, you do not touch the long side. No volume equals noise.
Okay, let's get the hard numbers on the board. If you're sitting at your terminal right now, where are the lines in the sand? Let's start with the ES.
The pivot for today is 6,125. That's the battleground.
6,125.
Yeah, if the bulls can manage to hold the price above that, your upside target is the all-time high at 6,180. That's the best case scenario.
And if we reject at 6,125,
Then the bears take the wheel. We'd be looking at a mean reversion trade down to 6,080.
which there's the trapdoor.
Yeah, the trapdoor at 6,095.
Why that specific level?
It's the 20-day moving average. In a choppy, low liquidity market like this, the 20-day is the floor. If price breaks 6,095 with any real conviction, the buy the dip crowd is going to get run over.
Because the automated risk models flip.
Exactly. The big funds flip to sell, and it triggers a cascade.
Got it. So 6,095 is a line between a bad day and a total disaster. What about the upside resistance?
Resistance is parked heavy at 6,160. The sources note there's just a wall of sell orders sitting there. It's a massive fake-out zone.
Okay.
We might wake up to touch it, but without that 30% volume spike, we're not getting through.
Let's shift gears to the NQ. Tech has been the engine of this market for years, but looking at the pre-market, the engine is sputtering.
It's definitely cooling. The Mag 7 are just chopping sideways. Investors are totally paralyzed waiting for that March FOMC guidance.
What's the line in the sand for the NASDAQ futures?
21,450.
Okay, 21,450.
Hold above that, we could see a short-term squeeze up to 21,700. But if we lose 21,450, the weakness is going to accelerate fast. You're looking at a quick flush to 21,200.
Is there any safety net down there?
Critical support is at 21,250. That's the high volume node from last week's trading, so there's a lot of trap liquidity there. But if that breaks, look out below. Momentum is stalling out, and growth is priced to absolute perfection right now.
And any headline risk is amplified.
Yeah, the sources emphasize that any minor negative headline on chip supply chains could easily flush this market.
Well, speaking of negative headlines, that is the perfect segue. We're seeing a massive narrative shift in the research called the post-earnings hangover. Money is moving, but it's leaving the usual suspects. Let's talk about the tech wreck gapping down in the pre-market.
It's significant. Just look at NVDA. NVDA is down 1.8% pre-market.
And this isn't just general market malaise. There's a specific rumor coming out of the Taiwan supply chain.
Right. The rumor is a 10% production cut for the Rubin chip architecture. You have to understand the stakes here. Rubin is supposed to be the next quantum leap after Blackwell.
It's the entire future revenue model.
Exactly. So if they're cutting production on the future flagship hardware,
It implies the hyperscalers are tapping the brakes.
Microsoft, Amazon, Google, if they're slowing their spend and the AI hardware cycle is actually peaking, the floor for the entire NASDAQ just drops. NVIDIA has been the Atlas holding up this entire market for 2 years.
If Atlas shrugs, the sky falls.
And it's not just NVIDIA feeling the heat today. Apple is down almost a full percent.
Yeah, Goldman Sachs came out with a downgrade. Moved them from buy to hold.
The reasoning is pretty brutal, too. Saturated Vision Pro adoption and cooling services revenue. The whole supercycle narrative for Apple is taking a direct hit.
So the two biggest names on the board are red, but it's not a complete sea of red. JP Morgan is actually gapping up 1.2%.
And that's your flight to quality trade playing out in real time. Jamie Dimon signaled a surprise dividend hike over the weekend, citing excess capital resilience.
In a market nervous about PE ratios, investors run to cash flow.
Exactly. JP Morgan is a fortress balance sheet. Capital is just hiding out there right now.
This connects perfectly to the broader theme we're seeing in the research, the great rotation. Moving from software as a service to real-world AI, the physical infrastructure play.
I think this is the most important macro trend of 2026. For the last few years, all the smart money was in the code. The LLMs, the software.
But we hit a physical wall.
We hit a massive physical wall. Data center power demands have capped out.
Yeah.
You cannot just write more code if you literally don't have the electricity to run the servers.
So efficiency isn't a luxury anymore.
What's a necessity for survival? The smart money is fleeing pure play software and pouring into the companies that actually build the grid, the cooling systems, the physical backbone.
Okay, so if we are buying software and institutions are hunting for this physical backbone, what are the actual tickers they're buying? The sources call today a Stock Pickers Monday. Let's look at the gap and go setups.
First one on the radar is Vertiv Holdings, ticker VRT.
The liquid cooling play.
Right, high-density liquid cooling. As these new chips like Blackwell 2 go live, they run incredibly hot. Standard air cooling just fails. You need liquid, and Vertiv is the market leader.
Give us the levels.
The bull case requires a clean, high-volume break above a 142.50.
No.
If it breaks that, it signals institutional accumulation is stepping in. Target is 150.
And the bear case.
Fail at 131.00. Drop below that, and the infrastructure fatigue narrative takes over. It'll slide.
All right, VRT at 142.50. What's next?
Palantir Technologies, PLTR.
Palantir has been a battleground for years. What's driving the pre-market volume today?
Rumors of a massive sovereign defense contract in Northern Europe, Relative volume is tracking at 3 times normal levels right now.
3x volume pre-market is not retail traders on Reddit. That's institutional flow.
Big money positioning. Bull case is sustained volume above 54.20. Hold that, and it confirms the transition from a meme stock to a critical sovereign defense layer.
But if it flushes?
If it loses 48.0, the hype is priced in, and short-term momentum traders will dump it hard.
Okay, one more. This one feels a bit more speculative, but it fits the power theme. OKLO Inc., ticker OKLO.
The small modular reactor play. Nuclear energy, they just got a regulatory green light update in the EU.
Nuclear is the only way to solve that power demand wall we just talked about.
It's the only scalable zero-carbon solution for these massive data centers. The levels here are super tight. Bull case is a candle close above 24.0.
Which triggers the options chain.
Right, we could see a gamma squeeze. Dealers forced to hedge, driving it up to 29.00, but dip below 19.50 and momentum is dead. Institutions will just wait for a cheaper entry, around 16.0.
So Verti for cooling, PLTR for defense, OKLO for power. It's all physical moat.
If the sector doesn't have a physical moat today, the money isn't flowing there.
Now here is where it gets really interesting. We need to zoom out to the macro overlay. I'm looking at the data, and there's a massive divergence happening.
The bond market.
Yeah. The 10-year yield is down to 4.08%. The dollar index, the DXY, is down to 97.51. Usually, a weaker dollar and lower rates are pure rocket fuel for tech stocks.
Usually.
So why are the futures flat? Why isn't the NASDAQ gapping up 2% on this news?
This is the critical insight for today's open. You have to look at why rates are down. They aren't dropping because the economy is healthy or inflation is suddenly solved. They are down because of geopolitical fear.
Specifically the tariff news.
Right. President Trump's pivot to a 15% global tariff over the weekend. This comes right after the Supreme Court struck down those reciprocal duties. The market is violently reacting to the threat of a trade war escalation.
So the drop in the DXY isn't good news for multinationals.
No, it's a flight to safety, but importantly, not a flight to the dollar. Investors are actively fleeing to the Japanese yen and the Swiss franc. That capital flight is dragging the dollar index down. The market is pricing in severe supply chain disruption, not interest rate relief.
That makes total sense. The algorithmic models see rates down and trigger buy signals, but human portfolio managers see trade war and hit sell.
Total conflict in the tape. And this sets up what the sources are calling the pain trade. This is the macro risk that retail completely ignores until it blows up their account.
Define the pain trade for this specific setup.
It's when asset correlation hits 1.0.
Meaning everything moves in the same direction.
Meaning everything goes down together. Here is the nightmare scenario the institutions are hedging against today. Foreign nations decide to dump U.S. debt in retaliation for these 15% tariffs.
Sell America Inc.
Exactly. If they aggressively sell U.S. treasuries en masse, yields are going to spike.
Okay, yields spike, which crushes growth stocks.
Right. But at the exact same time, the broader stock market is selling off because tariffs destroy corporate earnings margins. So you get a scenario where yields violently spike back toward 4.30% while the major indices are crashing.
Retail loses on both sides of the portfolio.
Usually you hold bonds as the ballast, they protect you when stocks fall, but in a correlation 1.0 scenario, your safe defensive tech stocks like Apple get crushed by the yield spike, and your actual bond ETFs lose value because yields are rising.
And there's nowhere to hide.
Nowhere. That's why you have to watch the 10-year yield like a hawk off the open today. The critical level is 4.0%. If yields break back above 4.0 despite all this trade war noise, the bond market is telling you that inflation and foreign debt dumping are the real priority. The rates are down by signal you're seeing right now. It's a complete trap.
All right, let's pull this all together before the bell. We are looking at a highly deceptive pre-market tape, a flat S&P that's secretly in a defensive crouch.
A liquidity vacuum.
We've got a historic rotation playing out money-fleeing saws and hunting for physical infrastructure moats like Verti and OKLO. And we're navigating a geopolitical minefield where the standard correlations between the dollar, yields, and equities are totally broken.
It's a dense tape to read today. But if you strip away the noise, the bottom line from the research is very clear. Don't trade the index, trade the flow.
The broad market is trapped in a box.
Yeah, the real alpha is in specific sectors: energy, defense, infrastructure.
And stay away from market orders. Limit orders only at the extremes.
Capital preservation is job one today.
Before we wrap up, I want to leave you with one final thought to chew on. You mentioned the NVDA rumor earlier, the production cut on the Rubin architecture.
Yeah, the Taiwan supply chain chatter.
If that proves true, If the hyperscaler hardware cycle is actually slowing down, what does that mean for the entirety of 2026?
That's the billion-dollar question. If NVIDIA is quietly cutting production, it implies end market demand is not infinite. It forces every manager to ask, was the entire monster rally we traded in 2025 just pulled forward?
A completely front-loaded cycle.
Right. And if the AI hardware cycle has officially peaked, are we staring down the barrel of a lost year for the NASDAQ? Because if the engine starts, the car doesn't just coast forever. Eventually, it rolls backward.
A sobering thought to start your trading week. Keep your eyes on those levels. 6,125 on the ES, 21,450 on the NQ, and watch that 10-year yield at 4.0.
It's going to be a highly technical week. Stick to your risk parameters.
Stay sharp, everyone. The bell's about to ring. Let's get to work.